Should I buy stocks now? Let's analyze the market together. Now that the stock market has crashed, is on the rebound, is it a good time to purchase stocks? Or is it better to purchase something else? As you probably know, I am mostly into physical precious metals. But a good investment is a good investment, no matter what it is. For the past 5 years, the stock market has been overvalued and was really a bad purchase. The only reason it did not correct or crash sooner was the constant manipulation from the Fed and the government, inflating the bubble to a level never seen before. Now that the stock market crashed 37% and rebounded, are stocks now at a price worth purchasing? This is what we're going to take a look at. I have chosen 10 stocks to evaluate based on fundamental analysis. This analysis determines if the price of the stock reflects the profit that the company is making. If you like this type of content, subscribe to the channel so you don't miss out on any future videos. Hitting the like button will also let me know that you want to see more videos like this. Please note that the opinions expressed in this video are my own. I am not a financial expert nor a financial advisor. You should always do your own research before making any financial decisions. There are several ways to evaluate the value of a company. I will use the easiest and the fastest one, the PE ratio. This stands for price to earnings ratio. It compares the price of the share compared to how much money the company is making. Let me give you an example. Let's say company ABC has 1 million shares selling for $10 each. That means that the company is worth $10 million. If company ABC makes $1 million in profit for the year, that would mean its price to earnings would be 10 millions divided by 1 million, or, to simplify it, 10 to 1. A fair valuation for a company is around 15 to 1. The lower the number, the more profitable the company is compared to its share price, and thus the more attractive it is to purchase. A company with a ratio of 20 to 1 or higher is usually considered overvalued and is too expensive to purchase. This is one of many ways to determine what shares are worth buying and which ones are not. So let's have a look at some of the major companies shaping the stock market and see if now is a good time to buy or not. I have not looked at any of those yet, but I have chosen them for reasons I will explain for each one of them. So the tool I'm using is called Finviz. You can simply go on their website and you'll have access to all of this data I'm showing you. This is updated in real time, so the data I'm showing you is current as of today on April 19th. So let's start with one of the best managed companies. Berkshire Hathaway is a conglomerate that holds several very large companies and is the company that is under the control of Warren Buffett. So Berkshire has several types of stocks. We're going to look at the common stocks, which is their B stock here. There we go. So the current PE ratio for some reason is not shown right now, but their forward PE is what is expected for the next earnings report, and it's showing at 17.03. So that's pretty good. It's a little bit overpriced, but not by much. Considering the state of the market right now, that's a very good ratio. How this ratio will change in the next few months is hard to determine. Usually Warren Buffett purchases companies that are very strong no matter what type of market they operate in. So this is why the price right now, even though the market has crashed and is in a recovery, is still showing a good number here. My thinking is that this ratio will increase because all companies right now are losing a lot of money. So even with very good companies, very well positioned, they're not going to make as much money as they normally would. So this would probably go higher unless the price of the stock went down. So if the price of the stock went down, obviously it changes the formula and you get a better ratio at that point. But let's say it keeps at the same level or goes up, then the PE ratio would normally increase because the profits are not going to be as good. Now let's have a look at one of the largest companies on the planet, Apple. So the ticker for Apple is APL. So Apple currently is at 22.33, which is a little bit oversold. So the price is a little bit high compared to what it should be. Their forward PE ratio is 18.75. I really doubt this number is good. I can't see people going out and purchasing phones and tablets and laptops and things like that in large numbers when, you know, they are not earning any money. So this was probably issued before the crash and before the pandemic. So it's probably a bad number. I'm thinking that this number will go up a lot. You're probably, for me, I would not be surprised to see 30 or 35 here. So we'll have to see at the next earnings report. But right now it is oversold. And I would not, as I said, I would not use this figure as a good indicator of what things are to come. Okay, so far we have Berkshire, which is an okay buy. If I had to put money into the stock market right now, that would probably be one of my first choices, seeing that the numbers are good. Apple, I think, is oversold, so I would not purchase it. Let's have a look at the next one, which would be McDonald's. So McDonald's, even though it's a restaurant, most of their profit comes from the real estate. So what they do basically is they rent the land on which the restaurants are operated on. So the money is actually rent money, not actual sales per burger and things like that. So it's a company that will stay stable even in a bad market because of that, because the revenues of the companies are not based on the direct sales. Of course, if restaurants were starting to shut down and close and go bankrupt, then it would affect their revenue. But at the moment, I don't think this is a major issue for them. So, and so the numbers that we see here, again, are a little bit oversold. It's a little bit expensive. And their forward PE is about the same number, but again, I don't think this is these numbers, the forward PEs are going to be valid because of everything that's going on right now. So you can expect this to increase as well. I don't know by how much, but it should normally go up a little bit as well. So again, I would not be purchasing McDonald's. It would be too expensive for me because of the current valuation. Now let's have a look at another very stable company that should not be affected too much by the current pandemic. That would be Coca-Cola. I believe the ticker is KO for Coke. Yeah, here it is. So the Coca-Cola company. See, again, it's not bad. It's not good. I mean, you do want to see 15 or lower in order to invest, but at 23, it's not awful. I must tell you, I've seen really, really high numbers in the past, and this is not bad. This is a very good company, super stable. They have a very stable market. I don't think because there's a pandemic, people will stop drinking Coca-Cola. Again, their P ratio, the forward P is a little bit better than the current one. I don't know if I would believe that. I'm expecting this to go higher. I don't think, unless, everything started back up tomorrow and, the market recovered completely, there is no way a company would improve in this climate right now, where people are losing their jobs, they're not working. It makes no sense to expect better result than what we have presently. So again, I would not be purchasing that. I find that's too high in terms of valuation. And these are some of the best ones I could think of. So when we get in the lower tiers that I've planned, I'm sure the numbers will increase quite drastically from this. But these are what you can consider to be the most recession-proof companies out there. So the next one I wanted to have a look at is Procter Gamble. I don't know their ticker, so we'll have to hunt for it a little bit. Here it is, so it's PG, okay. So Procter & Gamble, basically they make cleaning products. So again, I don't think this type of company would have an issue with the current environment. But as you can see, okay, here we have a P ratio of 68 28.89, almost 69. So for every dollar they make, the company is worth almost $70. And that is really bad. I mean, there is no way the company should be valued this high. This is past bubble land. I don't even know how to name this type of valuation. It's absolutely crazy. They do expect the valuation to go back to 23.86. I don't know how they can expect that. Again, I would not take that as a good number. This would probably remain around that level or go higher, unless, of course, they expect the stock market to crash completely and that the price, is halved or even a third of what it is right now. So right now it's at 124. So that's a very good example of a company that should not be purchased with this valuation. So people who are doing so are probably just using technical analysis and looking at what the price has been doing, and have not looked into the numbers of what the company is actually worth. And this is one of the major issues right now with the stock market, especially with the ETFs, because they will purchase pretty much anything. It no longer matters if the company is good or not, if it's valued correctly or not, they simply purchase. So there's probably a lot of ETFs purchasing at Procter Gamble because it's a large company. And this is very likely one of the reasons the PE ratio is so high. Now let's have a look at a company that should be doing very well in this environment. That would be Netflix. People are all at home watching movies, so normally their membership should be probably at the highest level they have ever seen. So Netflix, I can't remember what the ticker is, so I believe it's something like that. Okay, there it is. Sorry about that. Okay, so yeah, okay. So Netflix right now is valued at almost 110. So for every dollars that the company makes during a year, the price of the company is $110. It's insane. I don't know how investors are expecting to make any money with this. It makes absolutely no sense at all. And right now is a very good period for them. So they do expect a forward PE ratio of 50. That I could probably believe, because I'm thinking that they're probably gaining a lot of subscribers right now. So in their case, whatever is happening around the world is probably helping them instead of hurting them. So, but even at 50, your valuation is at over 3 times what it should be. So I would not be purchasing that either. And that's one of the better companies right now. I mean, if you were to think which companies are going to make money, Netflix would be it. So it gives you a good idea of what the rest of the market probably looks like. So the next company I wanted to have a look at is Google. Okay, so yeah, it's called Alphabet now. I didn't remember, but yeah. I'm not sure why they have 2 ticker though. Let's have a look at this one. Okay, so they seem to have 2 different ticker. If someone knows why, please let me know in the comments. Okay, so they have both very similar numbers in all of the stats that I was looking at. So right now the PE ratio for Google is 26.01. They expect 22.28. Again, I don't know if that's realistic. Google makes most of their money in marketing, so they sell ads basically for their services. So the way I'm seeing it, probably that most companies are not going to be advertising as much right now. It's hard to say. I don't have a background in marketing, so I don't know what affects their market. But in my mind, like most of the companies are closed, so they're not going to be advertising. So it can't be a good thing for advertising right now. So I would expect the PE ratio to actually go up, not down. Again, depends if there was a second crash and it went really down, really way down. Then it would make the PE ratio much better. But if we were to stay at the same level or keep going up, then it would get much worse here. Another company I wanted to have a look at is Amazon. I believe Amazon probably will be making good business in this environment. There they are, Amazon. Okay, oh geez. Okay, so yeah, Amazon is at 103.18. Again, why would you invest in that? And look at that, their stock is climbing super fast. So that tells me that you know, the government is pumping money into that company. There's no way this huge leg up here is from private investor or even institutional investors. They must know that the numbers are not good. So the only way I can see that going up that much is direct pumping from the government, and it's not good. I mean, 103 is crazy high. We're looking at what, 7 times over what it should be selling for, something like that. It's at 23.75 right now. This is bubble land. So yeah, and they're expecting the P to drop down to 59. Again, I don't think that's realistic. The price seems to be going up, like the price keeps going up. They're probably at an all-time high right now. So how can their P, get reduced unless the price goes way down, or the profit increases by, they double their profit in the next 3 months? How would that do it? How is that possible? I mean, I don't see it coming at all in that way. So that was for Amazon. Another good company, I think, that would be making a lot of money right now because they're one of the only ones open to sell grocery and various things, would be Walmart. Okay, so yeah, see, Walmart makes more sense. So it is oversold. It's almost twice the price you would want to pay for it at almost, well, 25.46. They are expecting the forward P ratio to be a little bit lower. Again, I don't know if that's realistic. Maybe is in their case because everyone is shopping there right now since everything is closed. So they must be getting a lot more business than they normally do. But yeah, we would have to see in 3 months when the earnings come out to see how realistic this number is. But anyway, at 25, it's too expensive, so it's not something I would purchase either. And let's have a look at Costco, which is another company that will probably benefit a lot right now from everything being closed except them. And see, Costco is a very good company, but the price of the share is way too high. So 37, you're at over 3 times the normal valuation in terms of what the stock should be selling for. So again, it's not something I would purchase. For the Ford, again, I don't know. It's possible that it would drop. It's one of the companies that could do it maybe, but I don't think the Ford P ratio for any of the company can be trusted right now because there's too much change. It's impossible to predict how much money they're gonna make and where their stock will be at when the next earnings report comes out. And let's have a look at the last one. So I didn't want to go into all of the very bad companies. I wanted to show the best ones so we can have a look at, if it's worth investing in some of the very best companies right now. But Tesla has been on a crazy run last year. So let's have a look where it's standing at right now. Tesla Incorporated, there we go. Okay, so they're not showing a PE ratio. Again, I don't know why, but you see they're expecting their PE to be at 66.61 at the next earnings report. It's probably going to be a lot worse than that because I don't think anyone is purchasing cars right now. So they are making medical products. I believe they're making ventilators and masks and things like that. So they were able to convert some of their production and make money during the shutdown. But I don't think they're going to make as much money doing those than making cars. So normally this should go much higher. So at 66, it's way too expensive. We're looking at Jesus. You're looking at what, 30, so for almost 5 times what it should be selling for. So, and this is a popular brand. I mean, look at the curve in just a few months. They went from $300 on their stock and they went up to $900 and then crashed down to $350. And now they're on their way back up. And the company is pretty much shut down. Why is the price going up? It makes no sense. So this has been the same thing like I've been seeing for a few weeks now, where everything is shut down, but the values of the companies and the reports are going up. So this is clear manipulation. They're pumping money into it directly from the government. So they're just reinflating the bubble that was deflated, and at some point it's going to burst completely. And when it does, the more they inflate it with false value, like they're doing right now, purchasing things that are selling at 5 times what it should be selling, when it bursts, it's going to be devastating, basically. It will destroy all of the companies. So my conclusion on this is that it's not a good time to invest in the stock market. I'm expecting actually another big leg down on this chart. It's probably going to go down another 30% from where we are right now, at least. The fundamentals of the economy are getting worse. They're not getting better. And the prices are going up. So at some point, it won't be able to hold. So what do you guys think? Are you thinking into buying into the stock market, or have you purchased into the stock market expecting to make money on this run-up maybe? Let me know. And also I want to suggest a video for you. So if you're thinking about buying precious metal for your portfolio, I invite you to watch this video, Should I Buy Silver Now? In that video I cover the current state of the market, so it should give you some information that might be useful to you if you're thinking about purchasing either silver, gold, or platinum. I hope you enjoyed this presentation, and I thank you for watching, and I will see you on the next one.